Welcome back to the Make It Count podcast.
I'm Marcus Mire, founder of Mire Group CPAs and the Total Control Accounting System.
And I'm Tyler Warner, small business owner with a lot of accounting questions.
All right, Tyler. Today we're, I think, talking about a topic it's kind of been brewing for us for a couple weeks. And I think it's probably Quentin's idea, really.
Yeah, shout out to Quentin.
Shout out to Quentin, wherever he is. And that's compensation methods, but specifically kind of creative compensation methods. I want to say creative, we say non-taxable, right? So you want to pay your employees.
Okay, back up.
All right, let's do it.
I don't always think creative non-taxable. Like you just, when you're thinking creative, it's non-taxable. What does that mean?
They don't normally go together. So what I mean by that is, let's think of, we're talking about ways to pay somebody. So you, the business owner, to pay an employee, or to give them something, a benefit, a fringe benefit, that sort of thing, and it's deductible to your business, but not taxable to the employee.
Right.
So that's what we're talking about.
Yeah.
Yeah. Make sense?
That does make sense. That sounds very ideal, actually.
Yeah, well, it's kind of cool because if you think about it, there are ways for you to get creative with paying people without tying it to salary, right? To give them, so certain people value things over salary more.
Sure.
And the savings kind of compound too in the fact that if something is not a wage, so if I pay you $1,000, you pay income taxes on it, I deduct it. But you also have to pay Social Security and Medicare. You as the employee, it's deducted from your check. And me as the employer, I have to match your Social Security and Medicare. So if something gets outside of that, meaning if I convert something from compensation that is a wage to compensation that's a fringe benefit, I don't pay the payroll tax on it, and the payroll tax is not deducted from it for you. And it's non-taxable to you. So kind of a win-win-win.
Gotcha. So we're going to go through a list, right, of things that kind of fit that criteria.
Yeah, things that I think every small business can do or should at least be thinking about.
Okay.
So I got a couple just kind of, when we say them, some of these might be new to people, and we'll get into that a little bit. But some of these will be kind of old, tried and true. So let's get the first one will be 401k matching contributions. So you have a 401k plan, and just to kind of back up, bring it down a little bit, a 401k plan and being a retirement plan through the employer that employees can contribute to, so they can do it through their paycheck. If you contribute through your paycheck, obviously that's a reduction of your taxable wages as an employee. But so we're not talking about that part. We're talking about the component that is most 401k plans have a matching contribution. And it simply works like this. Most of them are around 3 to 4% matching. So if you make $100,000, Tyler, assuming, and we have a 3% match, assuming you put away $3,000 of your salary, the company would match it and put $3,000 into that account for you. That contribution would be deductible by the company, but not taxable to you.
Okay.
So pretty straightforward. I mean, I think most people kind of get that.
Sure, yeah.
Yeah, if you've worked in any type of business that has a 401k or a simple, or name your retirement plan, generally has some kind of matching component.
Right.
But I just don't think people realize that, that may be something to offer instead of an increased salary. Maybe increase the match, because it's not taxable. So,
yeah. All
right. So that's kind of easy one. I want to start us off with a simple one. All right. Health, dental, vision insurance.
Okay.
So this is obviously, health insurance being a big topic with lots of people, and that's a place I see businesses really differentiate themselves in terms of building packages for employees that they value. A lot of times now, it's, again, I keep harping on this. It's not always about the salary. It's about these other things, and the health, I say health, dental, and vision, the health being the largest component of that. Yeah, well, being a huge piece.
You'll hear people keeping a job, like you'll meet, like we have friends, it's like, oh, yeah, my wife has that job just for the health insurance for our family, or
for sure,
or vice versa.
Yeah, for sure. And so obviously pretty simple. You have a group health insurance plan at your employer, and the employer contributes some or all of that premium. I know here we pay all of the employee premium, and then we pay some of the spouse and the children, and so the employee has to contribute, but that's not taxable to them. So it's a deductible to me or Mire Group, but not taxable to the employee. So really nice benefit, especially depending, it hits people differently. Like you just said, I've heard that same thought, like, man, my wife has kept this job for years because it has this great health insurance package. So it's just something to think about when you're thinking about how to compensate people. how to do it better, how to make your business a little more attractive, consider those. And then it's a win-win in that deductible by you, not taxable to them.
Yeah.
Yeah.
Are there like brackets? I know like if you've got a certain amount of employees or more that, it looks different or.
No, I think the only thing that gets, well, there's some rules around if you have to provide coverage, kind of based on the Affordable Care Act that came out years ago.
Sure, but that's like 50.
That's 50, yes.
Yeah, but I'm just thinking, if you've got 3 employees versus if you have 13.
The issue becomes, obviously the more people you have in a group, the easier it is to get a group, because you have to have, and this is going to get kind of into health insurance talk, but going through it recently, I have some insight, which is a certain amount of people have to get into the plan for you to have a plan. I think for us it's 75%. So there's some things you have to meet from a eligibility standpoint to even have a group plan. And that's what we're talking about when we're talking about health insurance and dental and all that.
Okay.
But I think everybody kind of gets those first two.
Now I'm just trying to think back, because we never had a health insurance group plan. But is there ways that you could just like cover your?
Yeah, it's funny you say that, because I've got that next on my list. I think
beautiful segue then.
I think that's what you're going for. I think it's next on my list. Oh, I had health savings accounts. All right, let's table health savings accounts. Let's get into health reimbursement arrangements. So health reimbursement arrangements are fairly, I'm going to say new, and as I say that, I'm not sure they're that new. I think they're more widely adopted now as opposed to in the past. So basically what a health reimbursement arrangement is, and as we're talking, I'm looking up the maximum or the contribution limits, but basically it works like this. If you were to give your employees a reimbursement for out-of-pocket health insurance cost, that is taxable to them. So contrast that with where we started, where we said we're trying to give people compensation that is still deductible by the company, but not taxable to the recipient or the employee. Mm-hmm. So if I would just say, Tyler, we don't have a health insurance plan here, but you work for us. Look, I'll throw you $500 to go get your own plan. That is taxable. I was going to say that's not taxable, but that's taxable to you. I can't reimburse you outside of some sort of plan. So that's where a health reimbursement arrangement enters. Health reimbursement arrangement enters in it's a plan where it's just that you reimburse people for legitimate healthcare costs, one of which would be their out-of-pocket premiums that they pay outside of your organization. And there's maximums for single and family. And the gist of the health reimbursement arrangement is this: you can't discriminate. You can't say, I'm going to give you $5,000 and this person $3,500. So as long as you meet certain criteria, the basics, and that's all we're talking about today is the basics, being you can't discriminate and you have to give certain amounts. You have to give certain maximums at either single or family levels. Well, it's a great little tool, because then
and when you mean discriminate, you mean like literally you could have, if you have 10 employees, you have to offer all 10 the same amount?
The same amount for single and family
You
plans.
can't just be like, hey, you've been with us 5 years,
That's
you
right.
get more.
That's right.
Okay.
Yeah. And as I say that, there may be some caveats to that for like a management or like a C-level.
Okay.
So I kind of reserve that. There may be, I hadn't gotten to the details of that, but I think there may be a little caveat or carve out for C-level. But most of the time, it's going to be you can't discriminate if people fall into the same category. So you being married with a family and this employee being married with a family, you have to give both the same access to a maximum.
Okay, sure.
And it's really cool. It's most of the time the way you'll have it is a third party will manage it for you. So they'll manage collecting the receipts or the documentation of what your employees are paying for out of pocket to get reimbursed, and then you've got your compliance covered and you've got the reimbursements covered. So it's a really cool tool. Kind of, we were talking a minute ago about, excuse me, our health insurance plan here and how you have to have a certain amount and meet the group. Well, now you don't have a group.
Right.
No issues where if you have like us, we have 5 employees. If somebody drops out, I mean, can you imagine? It affects the group materially. If I just had a health reimbursement arrangement, I could then just say, doesn't matter. I don't have a group.
That seems like the best way to go, I guess, until the group benefits outweigh what you could get in the market.
That's right. Know? Yeah, I mean, it's a little different, right? So you're kind of you're empowering your employees to go out and get their own health coverage and handle their own health care, and just say, hey, there is a maximum amount of dollars available to you to reimburse you. So it just depends.
Now, could you could you work it almost like as a fixed thing? Like you just say, hey, I'm gonna pay you $500 a month in this HRA, or does it literally have to turn in receipts every?
Yeah, I think it's kind of like I have on my notes here, accountable versus non-accountable.
Okay.
I think it falls under what would be considered like an accountable plan because it's a reimbursement. Anytime you start to give people dollars that are just a flat amount, that's more or less an allowance. And so allowances are different, where allowances can be taxable if you don't have the receipts to back it up.
Gotcha. This is the last question,
Yep.
but that manager that you mentioned, would
Right.
that be the function of them, where it's like just management in the background of
Yes.
like, okay, we like I'm thinking I buy it, it's, let's say it's $749.33 every month that I'm
Right.
paying for insurance. That automatically gets sent to my employer.
Right.
This third party manager automatically reimburses me.
Yeah, I think I don't know all the nuts and bolts about how the reimbursements get handled.
Okay.
But so I know like we use Gusto for our payroll here, and lots of clients
That's
use it.
kind of what I was thinking. Is there like a Gusto?
Gusto offers it, but I don't think Gusto, because I know, I'm going with my gut here. I know Gusto, if you have 401k, Gusto won't pay your 401k custodian. So my guess is Gusto probably spits out a report that says, hey, per your plan rules, these people have submitted these receipts and we find them valid. Here's the amount you need to disperse.
Yeah.
Yeah, or something like that. That's a good question.
Yeah, because if that was really tight, like,
Yeah.
and automated, then it would almost feel like a real, like, okay, this is like you guys covering our
I know,
health
and as you're saying
insurance.
it, I was like, I haven't done enough of these because it's just, like I said, they're not widely adopted. They're
Yeah.
getting more, but that's a really good
This
question.
podcast is certainly going to change
Oh,
that.
of course, yeah. I think Gusto needs to. There'll probably be a really big influx on the HRA at gusto.com.
Yeah.
Yeah. So anyway, I think that's a really cool. That's just a high level overview of health reimbursement arrangements. A neat tool to get around the group criteria, to give people some healthcare benefits, and put people in control of their healthcare.
Sure.
Kind of on that same vein, let's talk about health savings accounts. So you guys haven't? No, you had an HSA, I think, years ago.
Mm-hmm.
Like, what do you know about HSAs? I'll kind of flip the conversation here. What do you know about health savings accounts?
Well, they were just a savings account that we used to like go to the doctor,
Right.
and we had a debit card.
Yep.
So anytime we would go to like Walgreens, buy a prescription, buy Tylenol, if it wasn't with
Chocolate covered
other
almonds.
Yeah, exactly. Yeah.
No,
yeah.
that's
No, we never did that.
Rocky Road ice cream.
Yeah, pretty much. Any medical expenses
Right.
that we would use that debit card,
Yeah.
and that was pretty much it. It wasn't very sophisticated.
Yeah, so let's so that's the not very sophisticated answer. Sans the chocolate covered almonds on the Rocky Road.
Right.
But let's kind of get into the tax guts of it. So I'll give a little background and tell you why we recommend health savings accounts, and then we'll kind of get into the guts of them. So most people don't deduct their medical expenses. And the reason for that is because there's a really high threshold before medical expenses become deductible. Just to give you some numbers, if you and your wife make $100,000, you would have to, and medical is only deductible to the extent it exceeds 7.5% of that.
Right. And
So
we've covered that.
We cover that. So,
Yeah.
and then I'm gonna make the point about health savings accounts. So, you would have to have $7,501 of medical, out-of-pocket medical, to be able to potentially deduct $1. Because again, your threshold would be $7,500. Once you get to $7,501, you now have $1.
Yeah.
And then that dollar goes into the pool of itemized deductions that then have to exceed the standard deduction.
Right.
So, long story short, lots of hurdles to deduct medical. You got to be, your income's got to be low, and you've got to be sick, or both.
Right.
That's kind of the way I would describe it.
And what we talked about that last time too is that it's not an investment account. So
Correct.
it's not worth stockpiling a lot of money in there.
Right.
And I think that's ultimately why we abandoned it. It was like we found better insurance.
Yeah.
Because you can't pay your insurance premiums with
Correct.
that money either. So
Right.
it was just like we just had random money sitting in there that we were like,
Right.
okay. Fortunately, our health expenses weren't much more than
Yeah.
what our insurance was.
Yeah.
We're basically paying
Yeah.
insurance, and outside of that, it was like over-the-counter medication.
Yeah, so we'll talk about the reason why you would do it. You're kind of giving the reasons why it may not be good, and so what I would say
was
is
that not the direction we were supposed to go?
no,
in
it's
this?
not the direction. Totally derailed. That's okay. No, it's good. I mean, it's good kind of real conversation around this. But what I would say is, okay, but if you're already working for somebody and their plan is a high deductible insurance plan, and you're going to have co-pays, doctor visits, um, prescriptions, name your thing. I would think all those things would, absent a health savings account, if you make a decent amount of money, are not going to be deductible. And let's just assume if you and your wife have 2, 3 kids, you got at least $1,500, $2,000, $2,500 of that a year that you're paying. It's not going to be deductible. That's where the HSA comes in. HSA comes in and says, if I, as the employer or employee, but this conversation is around non-taxable compensation methods, if I contribute to your health savings account as an employer, it's not taxable to you, and then you get to use it to the extent you pull it out like you were using. I think probably had HSA Bank was one, a popular one, but to the extent you use it, swipe that debit card and use those funds, that money comes out non-taxable. So it goes into, you get it tax-free, and the money comes out and you pay your expenses, and now they're not those expenses come out, and you don't deduct them, but you don't pay tax on the money coming out.
Yeah.
So the point is, and if you made a contribution to the account, it would be deductible. So it either allows your employer to give you tax-free money or allows you to deduct things you otherwise wouldn't have. Like when you make the contribution, it's deductible, but you were never going to deduct those medical expenses.
Right.
And that's kind of the point. So a lot of people are starting to get to where it's like, I know Quentin told me he worked at an employer, and this was a cool deal. He said if you had a hospital stay, they would put $1,000 in your HSA. And so not taxable, but so it allows you to kind of be in the driver's seat as an employer about not having fixed cost that you can incentivize through an HSA, knowing that they're probably going to have out-of-pocket medical and use that money eventually.
Sure. Yeah, and I could see that just being another, if you're building a package for somebody, just saying, hey, look, you get an extra $2,500 a year in your HSA.
Right.
Or we have a policy around you have a hospital stay, or a family member does.
New child.
Yeah.
Maybe you do a new child bonus.
Yeah.
I think you can write these plans pretty liberally.
Yeah. So this is the creative part.
This is the creative part. Yeah.
Okay.
We got to it finally. So I mean, I'm a big proponent of health savings accounts just because if you're going to have out-of-pocket medical, you're probably not going to be able to deduct it. Either your employer contributes it and it's non-taxable, great, or you contribute it. If it's, think about the same dollars that you were going to spend out of pocket or put in the HSA, might as well get a deduction for it.
Sure.
Or if you're the business owner, incentivize your employees, give them another creative method, like you said. The have a new child, there's a new child bonus, whatever.
Yeah.
Yeah. All right. Makes sense?
It does.
Even though you don't particularly.
Yeah. Well, I'm gonna start now.
Well, you don't have a high deductible health plan. Well, that's one thing we did say. That's the crux of this. You have to be in what's called a high deductible health insurance plan. And I forget the numbers on high deductible. Right. But it's that plus there's some.
But you know it when you have it.
Oh yeah, you do. No, but it's not as high as you think. I don't even think it's around the $2,000 or $3,000 deductible. But there's also some parts of your plan that either qualify you for an HSA or not.
Yeah.
I always tell my clients, just call your health insurance company, call Blue Cross or Aetna or whoever you have.
Yeah.
Just say, hey, is my plan HSA compliant? They know right off the bat.
Yeah.
Yeah.
Okay.
All right. So you're going to get health insurance and an HSA?
We'll see.
TBD.
Yeah.
All right. Last one. I would kind of combine these things and this is kind of obviously popular now with, kind of the work from home crazy, which is you can reimburse your employees for their out-of-pocket expenses to work from home. And it kind of follows the home office rule. So if you ever had a business like you're a little side hustle or what I call a sole proprietorship, kind of where you don't file a separate tax return for your business, it's just a schedule on your personal, you've probably deducted a home office. And so basically what that is your expenses, mortgage interest, property taxes being the biggest ones, prorated to the square footage of the office as a percentage of your home. So a 200 square foot office over a 2,000 square foot home, 10% of all your expenses would be deductible for a home office. You'd follow that same logic for getting reimbursed from your employer tax-free. So if the employer says, hey, everybody's working from home, you could have that situation where you get reimbursed. It's kind of a nice thing. Again, not taxable to you. You are already going to incur property taxes and mortgage interest.
Where are you getting reimbursed?
From the employer. So you would tell.
Okay. I thought we were their employer, and you were saying.
Yeah, I'm kind of putting myself in the employee's shoes now.
Okay, gotcha.
To give you the math of how you would get to that deduction.
I see.
And then saying, but that's how you would calculate what the amount you can get tax-free is.
Okay.
And
so
then
when your employees file their return, they can get that.
You would give it to them. It'd be like something you would do as the employer, or kind of like this health reimbursement arrangement. Just say every month, and probably, here's what I would say practically speaking. What you're probably going to do is you're probably going to give them a flat amount and strongly suggest that they have the math to back up the amount you're giving them.
Okay.
Right? Because
Right.
that's what we're talking about here. We're trying to say, if you give me an allowance, that's not taxable to the extent I, the employee, have the expenses to back up what you gave me.
Gotcha.
And so that's what most people are doing. I think practically speaking, most people aren't saying, hey, I need you to turn in the diagram of the square footage of your house and your utility bills this month.
Mm-hmm.
But I'm trusting you that if we need to look into this, that you can produce the information that would back up the amount I gave you such that it would be non-taxable.
Sure. Okay.
And most people get enough to where their percentage of the mortgage interest, utilities, and all that would be more than the allowance you're getting.
Okay.
I think that's why people give a flat amount. It's also
Gotcha.
pragmatic.
Okay.
But in the tax world, just to be like certain or specific, accountable versus non-accountable plans are a thing. When I hand you an allowance, that's a non-accountable plan. It should be taxable to the extent you don't have expenses to back it up. Accountable plan being you hand me a list of expenses and then I pay you.
Okay.
So it's kind of in the middle ground right there. But again, that materiality kind of concept, most people are just practical about it, saying, if I need you to produce these expenses, I think we've got an agreement that you got them.
Gotcha.
Yeah.
And this would be the employer creating a benefit. Hey,
Correct.
look, if you work from home, we cover some
Yeah,
expenses.
yeah, we covered. Yeah, that's right.
And as a bonus, they are not taxable
right.
to you.
That's right. It's a cool
assuming
feature. I
you
mean,
follow these rules.
yeah, I mean, and so if like, let's just say the employer maybe they've cut down their office space and it's like they've got some dollars they're repurposing.
Yeah.
You know, it's
Or
like,
sure, so companies are starting that way.
Absolutely. I mean,
companies aren't,
yeah, and I'm kind of giving the example most people are used to now, which was they had an office, now they don't.
Right.
And so, hey, I'm gonna throw a few dollars your way. Win-win for everybody. It's not taxable to you. I get to repurpose my rent money, pay you something. You feel like I'm not just sending you home with no
Right.
reimbursement. So I think that's a really cool deal. And obviously, with included in that would be like your home internet. We do that here. I give a stipend every month for home internet, and then cell phone. If you've got to use your cell phone heavily for work, get that reimbursed.
Yeah.
You know, and most of these, I think the questions would be from a tax perspective. Well, how much can I give? I mean, I tell our clients, man, if they're using the internet, it's hard to make the case that shouldn't be 100% deductible. I mean, they got to have it to do their job. I think you can, and in the IRS and tax world, there's this concept of de minimis. Like if I have to have internet to work 40 hours a day, but my kids jump on the internet, I think would be kind of falling under that de minimis concept where we don't have to then carve out and say, no, not all of that's allowed.
I'm a little light on my Latin.
Yeah.
But I think I follow.
Yeah, it just means it's negligible.
Okay.
It's ancillary to the whole
Gotcha.
kind of thing.
Okay.
What other good word can I
That's
throw
what I
out?
say, man. You're dropping some bombs. That was like all 4-syllable
I have
plus.
those written on my hand here. Yep. So that's it, man. It's just 401k, health insurance, health savings accounts, health reimbursement, and then kind of this home office, cell phone, internet concept.
Yeah. Well, I think we started off saying, I mean, these are ways that you can creatively be competitive as you're, recruiting employees and talent and literally, I think we're at a place now in the job market, from what I understand, that like you got to be competitive.
Absolutely.
I mean, if you're good at your job, you got options.
Yeah, and look, you want the best people, man.
Right.
The best people are always worth it to provide for them, such that they make your business run better. I think that kind of goes without saying, but
Sure.
But I always tend to lean toward I'd rather up things and give people benefits and trust great professionals to do what they do than to nickel and dime.
Yeah. Good deal. Well, on that note, if you need other great resources, all the podcasts are available at Mire.group, and you can certainly reach out to the Mire Group there. And like you mentioned last time, you can reach out to you personally.
Yep.
Anytime. Love to get on the phone or conference call with people. Answer their questions.
I mean, the easiest way would be Marcus at Mire.group, Mire.group, or you can go right to my calendar if you'd like a book. I do 30-minute free consultations. That's Calendly, so calendly.com/Marcus Mire CPA. Literally go to my calendar, book some time, and I'll see you then.
Good deal. All right. Thanks, guys.
All right.